Welcome to Real Estate Economics webinar series. Real Estate Economics is a leading provider of residential market consulting services and online research tools. Real Estate Economics webinar series covers a variety of topics of interest to home building, land development, and lending industries, and to interested participants in the public and private sectors. I'm John Mulville, Vice President of Consulting at Real Estate Economics. I'll be presenting today's overview of Bakersfield and the Kern County MSA. I'll provide contact information for any questions or inquiries at the end of this webinar. You can always find webinar schedules and our company information at www.realestateeconomics.com. You can see the upcoming schedule here. Next week we'll cover Salt Lake City, 2 weeks Bay Area, 1 week off for Thanksgiving, and then Seattle. On December 8th, we'll be introducing our new Real Estate Economics website, and we'll wrap up the year of economic and housing market conditions on December 15th. To watch past webinars, access our YouTube channel at www.youtube.com/realestateeconomics. Click on the link at the top labeled All, and it will list our past presentations. From there, just click the presentation you want to watch and it will start. For those of you who have seen our past webinars, we like to cover conditions on the ground going back several years just to set the stage for our trend forecasts and our 5-year outlooks. This is December 2006 for Bakersfield. The county is large geographically. Most of the activity is in the Bakersfield area and its surrounding micro markets and sub-markets. As you can see in 2006, the market is dominated by conventional resales. Those are shown in blue on the map and in blue print in the table. The green new builder subdivision sales are green on the map again and green in the table. Foreclosures, those are lender repossessions, are shown in burnt orange on the map and red in the table, and foreclosure sales, that's lender out to new third-party owner, are in purple in the table but yellow on the map. You can see what this market looks like in September 2006 for that single month. New builder sales are prevalent across the area. This market has traditionally been dominated by the northwest submarket and southwest submarket with smaller numbers of sales in the northeast and very few sales traditionally in the southeast. You can see at this point in time conventional resales. Now that's a category that includes short sales, so in the coming years it'll be important to recognize that that's a category that includes all conventional non-distressed equity sales, but also approved short sales by banks. Market capture for those resales is about 2/3 of the market in September 2006. New builder share, 23%, a very healthy number, and the two categories of distressed are barely 10%. So this market's operating well at this point in time. This is a market that had plentiful, abundant subprime loans, liar loans if you will, tremendous loan suitability problems, which will ultimately set up the conditions for the price degradation over the next several years. But at this point in time, new builder sales running $357,000. This is a market area where the median household income in 2006 was about $42,500. So we're trading here some 8 or 9 times median household income, a staggering disconnect between the financial capabilities of the households in this area and new home prices. Resales are still more affordable, but they are also 5 to 6 times median household income. Let's come forward 1 year and you can see the change of condition and the character change on the ground. First off, you can see the density of the transactions has depleted significantly. Volume is way down as the initial signs of distress start to manifest themselves. Conventional resales are now only 42% of the total volume, down from 2/3 in the previous year. New builder sales 18%, down from 23%. And now the two categories of distress are almost 40%, up from just 10% in the previous year. Already at this point in time, the market's experiencing some employment losses. subprime resets, and different things that are forcing people without suitable loans out of their homes in short order. Resale values here now $250,000. New home values in this single year have come down from $357,000 to $301,000, but are still outsized given the median household incomes in this area. Let's come forward one more year and see again considerable character change on the ground. The intensity of the sales and foreclosure activity has grown quite a bit. Conventional resales, a very low number here, 25%. New builder sales, surprisingly, still getting about 10%. That's a single month's worth of recordings. 217 sales. Total distress categories now are over 60% and accounting for about 1,300 sales. You can see new builder prices down to $242 from $357 2 years previous. Conventional resales about to crack under the 200,000 benchmark. Still, the southwest market and northwest markets dominating the new home sales. Come forward one more year to September 2009. We've got a little bit of a rebound here in terms of market share attributable to conventional resales. Again, a category that includes short sales, so we're starting to see some initial short sales. New builder market shares down to 6.3%, and the foreclosure total numbers are over 60%, but numerically we're starting to see the first signs of a shift from lender foreclosures to short sales. Lenders are finding out at this point in time that short sale recoveries are substantially better than the recoveries and repossessions, and if there's someone in the home, hopefully they're mowing the lawn. It's surprising what we've seen in terms of short sellers. Many of them will take surprisingly good care of the homes. They'll flush the toilet and mow the lawn, and just having someone in the house often prevents some of the damage and vandalism that we see in outright repossessions. You can see the values continue to degrade here. There are many homes in this market without CFDs, without high taxes and homeowners dues that can be purchased, especially if they've just been built in the last 5 to 10 years. They can be purchased and put out on the rental market with a positive cash flow in pretty short order. If you see the foreclosure values here at the bottom left, $136,000. It takes very low rent, about $750 a month, to have a positive cash flow here. That's well within the affordable rental rates for this market area. Come forward to 2010. This is current information as it is processed and comes to us. You can see tremendous improvement here in the resale market share as the short sales continue to grow and be approved more quickly and in larger numbers by the lenders. There has been a tremendous backlog in many of these lending institutions as they set up the internal processes and staffing infrastructure to handle these things. But this is starting to accelerate in our view. We probably would have seen improvement here in the next month or two until we run into this robo-signing issue. Either way, many of these lending institutions have many foreclosures with complete paperwork that they can work on while they rehabilitate the paperwork on the other files. And so we think we're going to see foreclosures increasing here, and the speed at which the delinquency transitions into a short sale is going to accelerate. At this point in time, we still have distress over 60%, conventional resales now substantially under 200,000, and new builder sales down to 214,000. Because real estate economics is in this market every quarter surveying these communities, we can put together a very good historic look at competitive levels, prices, concessions, unit sizes, premiums, lot sizes, almost every element that you would need if you were trying to go into this market and decide where should I be positioned, what are my viable price ranges. Kern County, now recall these numbers are for all of Kern County, had as many as 89 developments in the third quarter of 2007. Most of the current 59 developments are in the city of Bakersfield itself. When this market heated up and the prices started to rise, many smaller and medium builders went out to smaller communities and put up lower price homes for people who couldn't afford Bakersfield. A lot of that activity has drawn down, and now most of the active communities are in Bakersfield itself. You can see unit sizes have stayed generally constant. I think this market's pretty much figured out about where it wants to be in terms of living area. Garage counts still vary, 2 and 3. Lot sizes are surprisingly consistent. Most lots are in this 6,000, 7,200, some 8s and larger lots. You can see sales rates over this time period have degraded. That can almost be seen better here in this particular table. This market's been running a little bit more than 2 sales per community. These are new homes only for the past 7 or 8 quarters. This tapered off a little bit in 2010 as we lost our federal and state tax credits, and now it's down to 1.7 sales per month. There is considerable seasonality in new home sales in Southern California, so we'd expect a slow fourth quarter, probably a slow first quarter, just with all the things that are going on the economic side, but we think 2011 will show some improvement. Here's the pricing trends. This market has held very steady at about $120 per square foot to $125 per square foot. Home sizes compressed a little bit, particularly new homes, as builders tried to improve the affordability, but now we're seeing those value ratios creep up. We'd probably prefer that those didn't creep up at the same time sales were declining, but these differences are fairly small, $1 here, $1 there, so the price discovery process is really fleshing itself out, and builders are beginning to get a pretty clear-cut picture of what sells, what are the price points, what do the buyers want, and how to effectively deliver new homes in this challenging environment. We're going to go on to our 5-year forecast, so be sure and join us for that section.